Hello, I'm Kim Stafford, and I'm here again with PIMCO Group CIO Dan Ivascyn to give you an inside look at some of the recent discussions taking place within PIMCO's Investment Committee, or IC. Thanks for joining us today, Dan.
Thanks, Kim.
PIMCO recently released our secular, or 5-year outlook titled The Fragmentation Era. In it, we talk about rising global debt levels and how that'll limit fiscal flexibility, while global trading alliances will fragment and potentially alter global asset flows and fuel volatility in the markets. Let's translate those longer-term views into actionable ideas for today. What can investors do in the second half of 2025 to position themselves for these longer-term trends?
Sure. Well, I think this year's price action and news flow is an example of how uncertain the macro environment is. But I think it's always important, particularly within the fixed income opportunity set, to remind investors that yield or current income drives a significant portion of fixed income returns. When you look at the performance over the course of the last year across high quality bond strategies, you're looking at mid-single digit, even high single digit type returns, even year to date, despite the fact that there's been a lot of volatility, a lot of concern around U.S. Treasuries, deficits, these types of fundamentals. The returns have also been pretty good. They've been particularly good if you've had a global opportunity set with non-dollar assets, higher quality emerging markets, doing even better than the U.S. market. So I think the first point is patience. The second point is appreciating the fact that we are in an environment with significant left tail and right tail risks. And there's going to be a lot of local noise. As an active asset manager, this is exciting. What we really try to do for PIMCO clients is to take a long-term orientation, use every tool in the toolkit, acknowledge fairly extreme uncertainty, but try to find resiliency across portfolios and generate a very, very attractive yield at the end of the day.
You mentioned that bond markets broadly have been performing well this year, and similarly, there are concerns about rising debt levels, particularly related to longer-term bonds. So, give us the state of the fundamental, outlook for bonds. What's changed, and what should investors consider?
Yeah, so there's really good value in global fixed income. Sometimes people yearn for the good old days, so to speak, the pre-COVID days, where debt levels around the globe were much lower. Inflation was very well behaved and quite low relative to where it is today. The problem back then is there was no value in fixed income markets. You took a relatively low yield, subtracted a relatively low inflation rate, you almost always ended up with a negative number. Yes, debt levels are higher today, but one of the reasons why you can lend to the U.S. government, to other foreign governments, to other high-quality corporate borrowers is because we do have high debt levels. And when you have high debt levels, we in the private sector get to benefit through higher nominal yields and higher inflation-adjusted yields. So, yeah, there's been a lot of talk this year about concerns about the fiscal picture, particularly here in the United States, when in fact, when you look at the performance of the bond market, you look at where yields are, the 10-year Treasury yield is about where it started the year, and returns are pretty good. Yes, longer maturities have underperformed, and a key theme of ours across portfolios the last couple of years has been to concentrate our interest rate exposure in shorter maturities. We don't have to take risk in the form of a 30-year maturity bond. We don't even have to take risk solely here in the U.S. market. So deficits are high. They're high in this country. They're not sustainable over the long run, but we do think that over the short term, even the United States running deficits in the mid-single digits are manageable, at least manageable in the sense that we'll avoid a crisis, we'll likely avoid any type of major capital flight. But again, we're not just taking that base case view for granted. We're looking to shield our client portfolios by, again, diversifying outside the U.S. and not taking massive amounts of interest rate risk to generate return.
You mentioned there are some concerns about the outlook for both U.S. long-term debt, as well as the ability for the U.S. dollar to continue its long-standing status as global reserve currency. So what is our outlook on the dollar and U.S. assets?
The U.S. dollar is going to continue to be the reserve currency over the course of the next few years. With that said, we can certainly continue to see diversification away from the U.S. dollar, away from U.S. Treasuries, away from U.S. assets, both fixed income, equities, and other areas of the market. The U.S. market and the U.S. economy, or at least risk markets, have performed extremely well in both an absolute and a relative sense. When you look at the U.S. dollar, you look at other risk assets here in the United States, they still are expensive versus risk assets or currencies outside the United States. So we do believe that over the course of the next few years, you could see this reversal of U.S. exceptionalism. You can see outperformance of assets, both in the developed markets as well as the emerging markets. And where we have flexibility on behalf of clients, we are looking and are, in fact, diversifying into some of those areas of the market. So, the United States is an incredibly vibrant part of the world, a very, very strong economy with significant momentum. A lot of this technological innovation, AI innovation, is emanating out of the United States. Despite more near-term uncertainty, we still have a wonderful business climate, here in this country. So it's not as if, we're looking to flee U.S. assets. It's just prudent diversification to try to reduce portfolio volatility and, most importantly, increase returns for end clients. And this is true of both the public opportunity set as well as the private opportunity set as well.
Give our investors a playbook for the second half. What investment opportunities are you most excited about?
Yeah, patience, avoid the noise, take a global opportunity set into account, and acknowledge that we have more economic uncertainty than we've had in the past. It's fairly symmetric. There's some scenarios where growth can remain very high or even reaccelerate, but recessionary probabilities remain elevated. So, over the course of the last few years, you really haven't had much in the way of an economic shock. Even during COVID, although we had the economic shock, we had massive fiscal and monetary policy stimulus. It didn't allow the typical cleansing mechanism across much of the corporate sector. So today, given that we have a little bit of froth, a little bit of complacency in the more economically sensitive areas of the credit markets, a real key to active management is trying to maintain an attractive yield while providing significant downside protection. It's not our base case that we're going to have a recession over the course of the next 12 to 18 months, but risks are elevated, probably closer to 30, 35, 40% versus the typical 20% range. And the great news is that there are resilient, liquid, global areas of the opportunity set where you can achieve a very, very high yield and have the type of downside protection which won't become apparent until you end up having that economic shock. So it may not happen over the next year or two, but investors should prepare for that and can prepare to do that, not hunkered down in cash or in the highest quality area of the opportunity set. Just again, a good diversified portfolio with significant downside protection.
Great. Thank you very much, Dan. And thanks to all of you for joining us. We'll see you next time.